Imagine a world where buying a piece of the entire S&P 500 index cost you thousands in fees, required complex brokerage accounts, and could only be traded once a day. That was reality just a few decades ago. Today, you can own a slice of hundreds of companies across diverse sectors with a single click for mere pennies and trade it like any stock. This seismic shift wasn't driven by a new government policy or a tech giant. It was spearheaded by a humble financial instrument that now manages over $12 trillion globally, the Exchange Traded Fund, or ETF. By the end of this video, you'll understand precisely how ETFs revolutionized the investment landscape, democratizing access to markets for millions, and why they become an indispensable tool in every modern investor's arsenal. We'll uncover their origins, explore their groundbreaking mechanics, and reveal their profound impact on market efficiency and individual wealth building. Before ETFs, the primary way for an average investor to gain broad market exposure was through mutual funds. These funds offered diversification, pooling money from many investors to buy a basket of stocks or bonds, but came with significant drawbacks: high management fees, often exceeding 1% annually, and the inability to trade throughout the day. You'd place an order, and it would execute at the day's closing net asset value, leaving you little control over price. This created a barrier, making diversified investing a slow, expensive endeavor for many. Then, on January 22, 1993, the financial world witnessed the birth of the SPDR/P 500 ETF, ticker symbol SPY. This wasn't just another fund, it was a hybrid, blending the diversification of a mutual fund with the liquidity and real-time trading capabilities of individual stocks. For the first time, you could buy or sell a basket representing the S&P 500 at any point during market hours, just like Apple or Microsoft shares, for a fraction of the cost. The initial expense ratio for SPY was a mere 0.2%, a stark contrast to typical mutual fund fees. The true genius of the ETF structure lies in its creation and redemption mechanism, known as the in-kind process. Unlike mutual funds that directly buy and sell underlying securities with investor cash, ETFs use authorized participants, typically large financial institutions. These participants create new ETF shares by delivering a basket of the underlying stocks to the fund, receiving new ETF shares in return, or redeem shares by returning ETF units to the fund in exchange for the underlying stocks. This unique arbitrage process keeps the ETF's market price closely aligned with its net asset value, ensuring fair pricing and remarkable tax efficiency for long-term investors. This innovative structure immediately began to democratize investing. Suddenly, a small investor, perhaps with just a few $100s, could purchase a single share of an ETF like VO, which tracks the S&P 500, and instantly gain exposure to 500 of the largest U.S. companies. The diversification once reserved for the wealthy or institutional investors became accessible to almost anyone with a brokerage account. This wasn't just about market access, it was about empowering individuals to build sophisticated, diversified portfolios without needing extensive capital or deep market knowledge. But the revolution didn't stop at broad market indexes. The adaptability of the ETF structure allowed for an explosion of specialized funds, pushing the boundaries of what was possible for retail investors. Today, we have ETFs tracking specific sectors like technology, XLK, or healthcare, XLV, country-specific markets, commodities like gold, GLD, or oil, USO, and even complex strategies like leveraged or inverse funds, though these carry higher risks. The innovation continued with thematic ETFs, allowing investors to bet on megatrends like artificial intelligence, BOTZ, clean energy, ICLN, or cybersecurity, BUG, providing highly targeted exposure that was previously impossible or prohibitively expensive to achieve. This proliferation of choice means investors can now construct highly customized portfolios with incredible precision. Want exposure to emerging market bonds? There's an ETF for that. Interested in companies focused on water infrastructure? An ETF exists. This granular control over asset allocation, combined with the inherent low costs, many core index ETFs now boast expense ratios below 0.05%, has fundamentally reshaped how portfolios are built, moving away from expensive active management towards efficient, transparent, and often passive strategies. The shift of trillions of dollars from actively managed mutual funds to passive ETFs over the past 2 decades is a testament to this profound change. However, the impact of ETFs extends beyond individual portfolios. They have significantly influenced market structure itself. The massive inflows into passive index ETFs have altered trading volumes and even the correlation of underlying stocks. When investors buy an S&P 500 ETF, they're not analyzing 500 individual companies, they're buying the market as a whole. This can lead to entire sectors or market segments moving together more often, driven by ETF rebalancing or large-scale buying and selling. While this generally enhances market efficiency by quickly incorporating new information, some critics point to potential risks, particularly in times of extreme market stress, where rapid ETF liquidations could amplify price movements. Yet, despite these discussions, the overall trajectory of ETFs points to continued innovation and integration into the financial ecosystem. We're now seeing the rise of actively managed ETFs, blending professional stock picking with the ETFs' trading and tax advantages, and non-transparent ETFs that disclose their holdings less frequently. Even the nascent world of cryptocurrency has embraced ETFs, with the recent approval of spot Bitcoin ETFs providing a regulated and accessible gateway for mainstream investors to participate in digital assets. These developments underscore that the ETF is not a static product, but a dynamic financial instrument continually evolving to meet new investor demands and market realities. The true revelation of ETFs is not just their mechanics or their low cost, it's the profound shift in power they represent. They stripped away the mystique and high barriers of traditional investing, giving individual investors unprecedented control, flexibility, and efficiency. They democratized diversification, made sophisticated strategies accessible, and empowered millions to build wealth on their own terms, forever changing the financial landscape from an exclusive club to an open marketplace. If you're looking to understand how to leverage this incredible tool in your own financial strategy, check out our next video on choosing your first ETF, a beginner's guide. Consider this: what other financial innovation has so thoroughly leveled the playing field for every investor, from Main Street to Wall Street?